Billions of dollars are flooding in. Analysts are racing to raise price targets. Retail investors are terrified of missing out. And somewhere, quietly, history is clearing its throat. Because we've seen this before. March 2000. Cisco Systems becomes the most valuable company on Earth, the backbone of the internet, the pipes, the routers, the future. Its technology was real, its growth was real, its dominance felt permanent. Sound familiar? Today, Nvidia stands at the center of another technological revolution: artificial intelligence. Its chips are the engines training the world's smartest machines. Governments want them. Startups need them. Big tech is hoarding them. And investors? They cannot buy fast enough. History doesn't repeat itself, but it often rhymes. At its peak, Cisco was worth roughly $550 billion, an almost mythical number at the time. Adjusted for inflation, it still wouldn't touch what we're witnessing now. Over $3 trillion. Let that number settle in. $3 trillion is larger than the GDP of most countries. It implies not just market leadership, but economic gravity. The expectation that one company will capture an enormous share of the value created by the AI era. So the question becomes unavoidable. Is this valuation justified by a once-in-a-generation technological shift? Or are we watching the early stages of the most sophisticated hype cycle Wall Street has ever engineered? Because every bubble is built on a story that sounds undeniable while it's happening. The internet was going to change everything. It did. But Cisco investors still waited over a decade just to break even. Now the world is telling a new story. One about AI, exponential growth, and limitless demand for compute. The chart is vertical again. The crowd is euphoric again. And the stakes may be higher than ever. Welcome to the Blueprint. Today, we deconstruct the most dangerous stock in the world. If Nvidia looks like an overnight success, it's only because most people weren't watching for the first 3 decades. The story begins in 1993, inside a Denny's restaurant in Silicon Valley, where 3 engineers sketched out a vision for a new kind of computing company. At the center of that conversation sat Jensen Huang, intense, precise, and already thinking several technological cycles ahead. Today, he's instantly recognizable on any stage. Black leather jacket, calm voice, surgeon-like clarity. But long before the market crowned him a visionary, Huang was simply trying to keep the company alive. The early years were brutal. Nvidia nearly ran out of cash more than once. Entire product lines failed. Competitors circled. Survival demanded a willingness to make decisions that felt reckless in the moment. Then came the turning point. The internal decision Huang would later describe as a bet the company moment. During the mid-2000s, Nvidia made a radical shift. Instead of designing chips solely to render video game graphics faster, Huang pushed the company towards something far more ambitious, turning the GPU into a universal computing engine. That required sacrifice. Famously, Nvidia removed the optical drive from one of its platforms, a symbolic but controversial move. Critics saw it as unnecessary. Engineers worried it would alienate customers. But Huang wasn't optimizing for the present. He was clearing space for the future. The future was CUDA. At its core, CUDA is surprisingly simple to understand. Normally, a computer's CPU handles tasks sequentially, one after another, like a single chef preparing an entire meal. GPUs, by contrast, can execute thousands of smaller calculations simultaneously. CUDA is the software layer that allows developers to tap into that parallel power without needing to rebuild their applications from scratch. But strategically, CUDA became something even more powerful: a moat. Once developers build on it, switching becomes painful. Tools, libraries, training pipelines, entire ecosystems begin to depend on Nvidia's architecture. Over time, this creates gravitational pull. The more developers commit, the stronger the lock-in. And the stronger the lock-in, the harder it becomes for competitors to catch up, which makes Intel's story all the more striking. For decades, Intel dominated computing with the CPU, the undisputed brain inside nearly every personal computer and server. But dominance can breed inertia. As workloads began shifting toward parallel processing, first in graphics, then in machine learning, Intel hesitated. While Intel protected its empire, Nvidia quietly built the infrastructure for the next one. By the time the AI boom arrived, the groundwork had already been laid. What looks today like perfect timing was actually the result of 30 years of disciplined positioning, technical bets, and a CEO willing to stake everything on a future few could yet see. Overnight success rarely happens. Sometimes it's just what 30 years of conviction looks like when the world finally catches up. At the center of the AI explosion sits a machine so powerful and so scarce that the world's largest companies are effectively standing in line for it. The H100. On paper, it's just another data center chip. In reality, it has become the single most important piece of infrastructure in modern computing. The H100 is designed for one thing: training and running massive artificial intelligence models at scale. Not incremental improvements, orders of magnitude gains. Tasks that once took months can now be completed in weeks. Models that were financially impossible suddenly become viable. And that changes behavior fast. Because when speed becomes a competitive advantage, hesitation becomes existential risk, which explains the price. Each H100 reportedly sells for $30,000 to $40,000 per chip. And the largest AI clusters don't buy them by the dozen. They buy them by the tens of thousands. A single large deployment can quietly approach $1 billion in hardware. In most sectors of computing, prices like this would invite immediate undercutting from competitors. But here's where the story turns extraordinary. Even at those staggering prices, demand still exceeds supply. Now look one layer deeper at the economics. Nvidia is generating gross margins over 70%. For hardware, that number is almost surreal. Traditional chip companies fight for margins in the 50 to 60% range. Many hardware manufacturers operate far below that. 70% isn't just strong performance, it signals pricing power. It signals scarcity. It signals leverage. And leverage is what happens when your product stops being optional. We are now witnessing what can only be described as a big tech arms race. Microsoft is pouring tens of billions into AI infrastructure. Meta is racing to train ever larger open models. Google is defending its search empire while simultaneously building the next computing platform. None of them can afford to fall behind, because in platform shifts, second place often means irrelevance. So they panic buy compute. Not cautiously, aggressively. Data centers are being redesigned around GPU clusters. Energy contracts are being rewritten. Entire campuses are being constructed with one goal in mind: secure enough compute to compete in the intelligence economy. And in the middle of that scramble sits Nvidia. There's an old analogy from the California gold rush. Fortunes weren't reliably made by the miners. They were made by the companies selling shovels. Right now, Nvidia is the only shovel seller in the AI gold rush. Competitors exist, but ecosystems take years to mature. Software compatibility matters. Developer familiarity matters. Reliability matters. When billions are on the line, enterprises rarely experiment. They standardize, which creates a feedback loop. More buyers to more developers, to more optimization, to better performance, to more buyers. It starts to look less like market leadership and more like gravitational dominance. But the deeper implication isn't just about revenue, it's about control over the pace of the AI revolution itself. When one supplier effectively determines how fast the world can build intelligence, that supplier stops behaving like a traditional hardware vendor. It begins to resemble infrastructure: railroads, electric grids, cloud platforms. The question investors must wrestle with is no longer whether Nvidia is winning. It's whether this level of dominance is sustainable. or whether history suggests that margins this rich inevitably attract challengers powerful enough to compress them. For now, though, the numbers tell a simple story: unmatched demand, extraordinary pricing power, industrial-scale profitability. This isn't just a great business, it's a monopoly machine in motion. But every empire, no matter how dominant, carries the seeds of its own vulnerability. And if you look closely enough, the cracks are already beginning to form. Start with the most uncomfortable truth for Nvidia investors. Its biggest customers are also its most dangerous future competitors: Microsoft, Google, Amazon. These are not ordinary buyers, they are hyperscalers, companies with nearly unlimited capital, world-class engineering talent, and a deep institutional allergy to dependency. No organization wants to build the future of computing on hardware controlled by another company, especially when that hardware commands premium pricing. Inside these firms, a quiet shift is underway. Microsoft is advancing its custom AI accelerators. Google has spent years refining its tensor processing units. Amazon continues scaling its Trainium and Inferentia chips. The strategy is straightforward: control the stack, lower long-term costs, and eliminate what many insiders have started calling the Nvidia tax. Because when you're spending tens of billions annually on compute, even modest savings compound into strategic advantage. Will these chips dethrone Nvidia tomorrow? No, but they don't have to. They just need to be good enough. History shows that when dominant suppliers push pricing too far, customers don't revolt, they innovate. And that leads directly to the next risk: the digestion phase. Technology cycles tend to follow a predictable pattern. First comes the build-out, euphoric spending, massive infrastructure, aggressive hiring. Then comes the hangover, when executives begin asking a far less exciting question: where is the return? Right now, many AI initiatives remain experimental. Revenue models are still forming. Monetization is uneven. Running large models is astonishingly expensive, and for all the excitement, few companies can clearly articulate the path from AI capability to durable profit. If boardrooms collectively reach the same conclusion, we've overbuilt, capital expenditure could slow abruptly, and Nvidia, for all its brilliance, is still tethered to customer spending cycles. Even a temporary pause could ripple through its growth narrative. Then there is geopolitics. China has historically represented a meaningful demand center for advanced chips, but tightening export controls from the United States have increasingly restricted what Nvidia can sell into that market. Workarounds exist: modified chips, regulatory navigation. Yet the trajectory is unmistakable. When technology becomes strategically sensitive, it stops behaving like a normal commercial product. Policy begins to shape revenue, and policy is notoriously difficult to forecast. Finally, competition is no longer theoretical. Advanced micro devices, long cast as the perennial challenger, is showing signs of real momentum in AI accelerators. Its latest architectures are attracting serious enterprise evaluation, and perhaps more importantly, customers appear eager for a credible second source. Not necessarily better, just viable. Because even the perception of choice weakens pricing power. None of these risks individually guarantees a reversal, but stacked together, they form a narrative investors should not ignore. Customers building alternatives, spending that could normalize. Geopolitical constraints, competitors gaining ground. Markets rarely punish strength, they punish expectations that drift too far from reality. And when a company is priced for near perfection, it doesn't take catastrophe to move the stock. It only takes disappointment. So, where does that leave us? Caught between two truths that refuse to comfortably coexist. On one side, the technology is undeniably real. Nvidia didn't manufacture hype out of thin air. It engineered the computational backbone of a new era. Artificial intelligence is not a passing trend. It is a platform shift, as foundational as the internet, as transformative as the smartphone. The demand for compute is exploding. Software is evolving at breakneck speed, and entire industries are being quietly rewritten by machine intelligence. History tends to reward the companies that build the rails beneath technological revolutions. Nvidia has already laid miles of track, But markets don't price the present. They price the future, and increasingly, they price the best possible version of that future. Today's valuation carries an implicit assumption that growth remains extraordinary, competitors remain contained, customers remain dependent, and margins remain historically elevated. It assumes execution without meaningful error. It assumes that the AI boom converts cleanly into durable profit across the global economy. In other words, it assumes perfection, and perfection is a fragile thing to underwrite, because great companies and great stocks are not always the same investment at the same moment in time. Even the strongest businesses can become dangerous when expectations outrun reality. We've seen it before. Dominant firms whose technologies changed the world, yet whose shares still endured brutal drawdowns along the way. The paradox is simple. Nvidia will power the future, but that doesn't mean the stock can't drop 50% first. For long-term believers, volatility may simply be the price of admission. For late entrants, it may become a harsh teacher. Either way, the story is far from over. What do you think? Is the bubble about to burst? Let me know in the comments. Subscribe for more deep dives.